saved up $100,000 and you're at a bit of a crossroads. You want this money to grow, but you can't afford to watch it take any big hits either. Sound familiar? Should you pick JEPQ, a tech-focused dividend-heavy choice? Or stick with VOO, the classic S&P 500 tracker and investor favorite? In this video, I'm putting JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, head-to-head with VOO, Vanguard's S&P 500 ETF. Both are popular options with strong track records, but they're built with different goals in mind. I'll walk you through each ETF strategy, look at their recent and past performance, and in the end, I'll show you how much return you can expect from a $100,000 investment over the next 10, 20, and 30 years. Both offer solid returns, but one has the potential to add an extra $1 million to your portfolio, while the other pays over $150,000 in annual dividends. So before jumping into any investment, it's important to understand the underlying structure and goals of both ETFs. Today I'm comparing JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, and VOO, the Vanguard S&P 500 ETF, both of which have different strategies and objectives. Let's start with JEPQ. As the name suggests, this ETF is focused on the Nasdaq. But it's not your regular tech-heavy NASDAQ tracker. It goes beyond just following a traditional index. JEPQ uses something called a covered call strategy, which means it generates income by selling options on its holdings, in addition to collecting dividends from its underlying stocks. The focus here is on income generation through its dividend yield and options premiums. Currently, JEPQ has a 9.5% dividend yield, which makes it an attractive option for income-focused investors who want a regular cash flow. However, you should know that this strategy can limit capital appreciation because the covered call strategy sacrifices some upside potential in exchange for those premiums. More on that later. On the flip side, VOO is completely different. It's a passive ETF that tracks the S&P 500, meaning it invests in the 500 largest U.S. companies. With this ETF, the focus is primarily on long-term capital appreciation. This ETF is perfect for investors who are more interested in watching their portfolio grow over time rather than seeking immediate income. VOO's strategy banks on the historical growth of the U.S. stock markets, and with an average annual return of 11.46%, it's hard to argue against its proven performance. The 1.27% dividend yield is a nice bonus, but it's really about long-term growth with VOO. Now that we have a basic understanding of each ETF, let's move into their holdings and diversification. When comparing ETFs, one of the key aspects to consider is what's inside the portfolio. After all, the companies these ETFs invest in play a big role in determining their performance, risk, and growth potential. Let's start by looking at JEPQ. This ETF is primarily concentrated in technology stocks, with 50% of its portfolio allocated to the tech sector. This isn't surprising, given that it focuses on the Nasdaq, which is dominated by tech giants. Some of its top holdings include big names like Nvidia, Apple, and Microsoft, which make up a significant portion of its portfolio. But JEPQ isn't all tech. It also has exposure to communication services at 15.84% and consumer cyclical at 13.79%, meaning there's a bit of diversification beyond just technology. However, compared to VOO, JEPQ is still quite concentrated with just 99 holdings. On the other hand, VOO offers a much broader exposure across various sectors. It holds 507 different stocks, offering a high level of diversification. While technology still makes up a decent chunk of VOO's portfolio at 32.34%, it's significantly more spread out than JEPQ. In addition to tech, VOO has notable allocations to financials, which is 12.86%, healthcare, which is 12.2%, and consumer cyclical, which is 9.86%. Its top 10 holdings, similar to JEPQ, include major players like Apple, Microsoft, Nvidia, and Amazon. But because VOO tracks the entire S&P 500, you're getting exposure to a much broader range of industries, including industrials, consumer defensive, and real estate. This level of diversification in VOO makes it a more stable choice for long-term growth, as you're not overly reliant on a single sector. Meanwhile, JEPQ's higher concentration in technology might make it more volatile, but also offers greater upside potential when tech performs well. In the end, I'll show you the potential returns from a $100,000 investment over 10, 20, and 30 years from both ETFs. Both perform well, but one has the potential to add over $1 million extra to your portfolio. With this in mind, let's look at how these ETFs implement their investment strategies to meet their goals. We've touched on this briefly, but let's dig deeper into the investment strategies behind JEPQ and VOO, because this is where the two ETFs really start to diverge. JEPQ has a strategy designed to maximize income. Its approach is solely income-focused, using the covered call strategy. Here's how it works. The fund holds stocks like Nvidia, Apple, and Microsoft, then sells options on those stocks. In doing so, it generates income from the premiums collected on those options. This income, combined with the dividends from its stock holdings, allows JEPQ to offer its investors an attractive dividend yield currently sitting at 9.5%. But as I said before, the trade-off is that this limits the fund's potential for capital appreciation. By selling calls, JEPQ caps how much upside it can gain from stock price increases, meaning you may miss out on some growth if these stocks rally hard. On the other hand, VOO follows a more traditional buy and hold strategy. Because VOO is a passive fund, its goal is simple: to replicate the performance of the S&P 500 index. It doesn't try to beat the market or generate extra income through options trading like JEPQ. Instead, it holds a basket of stocks that make up the S&P 500 and lets the market do its thing. Over time, this strategy has proven to be highly effective, with VOO delivering consistent growth year after year. The simplicity of VOO's strategy is part of its appeal. It's designed for long-term investors who want to build wealth gradually through capital appreciation. Both strategies have their merits, and which one is right for you will depend on your personal financial goals. If you're looking for regular income and are okay with sacrificing some growth potential, JEPQ might be the better choice. But if you're more interested in long-term growth and can handle short-term market fluctuations, VOO is likely a better fit for you. Now, when it comes to performance, history matters. It gives us a sense of what we might expect in the future, even if there are no guarantees. So how have JEPQ and VOO fared in the past? This time, let's start with VOO, which has a much longer track record. Since its inception in 2010, VOO has delivered an average annual return of 11.46%, which is highly impressive for an ETF. Over the past 10 years, VOO has seen a price return of 187.93%, meaning it's more than doubled in value. If you had invested $100,000 in VOO 10 years ago, your portfolio would be worth around $325,070 today, not even including the dividends. This kind of performance is one of the reasons VOO is a go-to option for long-term investors looking for steady, reliable growth. But is growth alone enough to make VOO a winner here? In the end, I'll show you which ETF will add an extra $1 million to your portfolio. JEPQ, on the other hand, is much newer, having only launched in 2022. Because of its shorter lifespan, it doesn't have the same historical track record as VOO. Over the past year, JEPQ has delivered a price return of 17.78%, which is respectable, but not quite on the same level as VOO's 36.81% return in the same period. However, JEPQ's strength lies not in its price appreciation, but in its income generation. Thanks to its covered call strategy, it can offer a much higher dividend yield, currently 9.5%, compared to VOO's 1.27%. The key takeaway here is that VOO is the better option if you're seeking long-term capital growth, while JEPQ is more focused on delivering consistent income through dividends. But numbers don't lie, and now it's time to put those numbers to work. Let's project what yours and John's $100,000 investment would look like in each ETF over time. Here we go. Let's run the numbers. If you and John are investing $100,000 today, how will it grow over time in JEPQ versus VOO? Well, I've projected the outcomes over 1 year, 10 years, 20 years, and 30 years, factoring in each ETF's dividend yield, capital appreciation, and dividend reinvestment. Starting with JEPQ, it has a current dividend yield of 9.31%, but due to recency bias, let's assume it maintains a 5% yield for the coming years, with a dividend growth of 6%. Additionally, since inception, it's had an average share price appreciation of 4.22%. Based on these metrics, in the first year, your investment would grow to $109,220. Over a 10-year period, this investment could increase to $251,004. Looking further ahead, after 20 years, your $100,000 investment in JEPQ could grow to approximately $692,768. By the 30-year mark, the value could reach an impressive $2,138,780. This figure includes $744,633 from capital appreciation and a substantial $1,294,147 from reinvested dividends. After 30 years, you could be receiving around $13,206 per month in dividends, totaling $158,475 annually. The big question is, can VOO beat that? Well, let's find out. If you decide to invest $100,000 in VOO, how does it stack up over the same period? With a current dividend yield of 1.27%, a dividend growth rate of 7.19%, and a stronger average share price appreciation of 11.46%, VOO has the metrics to challenge JEPQ. Based on these metrics, in the first year, your investment in VOO would grow to $112,730. Over 10 years, the amount could triple to $325,070, driven by the robust price appreciation. After 20 years, your $100,000 investment in VOO could grow to approximately $1,022,292, almost doubling the 20-year value of JEPQ. By the end of 30 years, the value could reach an extraordinary $3,146,685. This total includes $2,915,425 from capital appreciation and $131,260 from reinvested dividends. By then, you could be earning around $10,082 in annual dividends. So, which ETF is the better investment for you, JEPQ or VOO? Ultimately, the answer depends on your financial goals. If you're looking for long-term growth and can ride the waves of market volatility, VOO is the clear winner. It has a long track record of strong returns, offers diversification across sectors, and is a low-cost way to invest in the U.S. economy. But if income is your primary goal, whether you're in retirement or simply prefer a high cash flow, then JEPQ could be the better choice. Its high dividend yield and income-focused strategy make it ideal for investors who want to see regular payouts, even if it means sacrificing some potential upside.